I think it's important if you look at the trajectory of the equity markets across the globe year to date. Both the U.S. and Europe really fell quickly earlier in the year, but the U.S. Recovered more quickly. And so I think what you're seeing right now is Europe playing a little bit of catch up to the previous gains that the U.S. saw. And it's natural, given the valuation discount that European equities have and the cyclical bent that the European market has, that you should expect to see that in the recent days, but also in the coming weeks.
You've given us some names to take a look at, and LVMH in the luxury space is one of them. We've got renewed tensions around Hong Kong, protesters on the street. I mean, we know there's significant operations for many of the luxury companies in the territory. Are you concerned about that story and the impact that it has on the luxury trade?
I think it's important to take a long-term perspective when investing. From our perspective, it's important to focus on sustainable business models that can drive long-term wealth creation for investors in our funds. And I think LVMH is a good example of a company that we think has great fundamentals in terms of a portfolio of leading global brands, pricing power, and really taps into emerging markets wealth creation. And from that perspective, the company is well positioned for the long term. The COVID-19 crisis and pullback in the equity market that has accompanied that really created some opportunities to gain exposure to businesses like LVMH that have great top-line secular growth, good gross margins, and high returns on invested capital. Those are the components that we believe are important for compounding wealth, both from an earnings perspective, but also for an investor's perspective.
Chris, you pick out some other interesting companies like Straumann and Dassault Systems, and on the face of it, they match all the criteria that you talk about. The trouble is everybody else knows that as well. So if you're buying a Dassault Systems at 68 times earnings, you're hoping, aren't you, for a lot of good things to fall in place over the medium term to justify that current rating?
That's right. I think headline valuations across most sectors in the current market environment are challenging because earnings have fallen quite significantly, the outlook for earnings. And so what we'd like to do is look at sustainable, normalized earnings when the recovery comes. It's difficult to say exactly when that happens. We're not in the business of trying to predict whether there's a recovery next month, next week, or next year. What we would like to do is position ourselves for those normalized earnings that we do expect, given the positioning of those businesses. Each of those three companies that you mentioned is the world leader in its market segment and have very good structural positioning in those markets, long-term secular tailwinds of growth. And so, it's important to be patient. It's tempting right now in this market environment to try to pick the lower quality businesses that you expect will bounce most quickly and most significantly. That can work for a period of time, but in terms of compounding wealth over a multi-year horizon, we really prefer to stick to the fundamentals that I laid out.